The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, Esther Gulius, the tax lady. Thanks for listening. We are talking about your emails and your texts that you sent us. I got Chris Fabian in studio, and next week we'll be back with our live phone-in calls. But during the week, you can call us at our corporate headquarters at 632-7886. You can go to our website at egtax.com. And we want to help you. It is not, when people tell me it's easy, it ain't easy. I mean, it's easy if you do it wrong, and as long as it's mathematically correct, they don't care that you didn't do the theory right.
Right? Yep.
Unless you were cheating. Okay, what else we got here, Chris?
Pauline, EG Tax. I just filed for divorce this month. We haven't lived together since February. He says we should file jointly again this year so he can claim me and my daughter. I only have a part-time job and make $10,000. So is he right? Do I have to file with him?
Well, as long as you're still married, you have that option, don't you, to file jointly?
Right.
But in this case, this sweet mama, Pauline, she qualifies for what we call the abandoned spouse ruling, right?
Yes.
So if she is even though she's still considered to be legally married as of 12/31, and I know that this is October, assuming that they're still not divorced by the end of the year, if they're still legally married, because she has a home that she's maintaining for a qualified child, then and he's been gone for more than 6 months, and the kid's been in her house for more than 6 months, and she's paying the bills, then she qualifies for head of the household, and the IRS considers her single for tax purposes. So because that would be the status, then she then qualifies for not only the child tax credit, but the earned income credit as well on the federal and the state, which means she gets a boatload of money.
Right. Oh my gosh. Yeah, the earned income credit, the child tax credit, the additional child tax credit. She's probably looking $5,000.
Yeah, on the federal, and probably another $1,500 to $2,000 on the state.
Yep.
Now, if she files jointly with him, which they can do because if they are still legally married, all he's going to do is benefit from the married filing joint rates, and he will get the $2,000, but he won't get the earned income credit unless his income were very, very low. But it sounds like he has more substantial income.
Right. Well, it depends, too, on, what is his income, because maybe married joint would give them more money than she would. You'd have to run the numbers and see, but then Pauline would have to be guaranteed, and we all know how that works, that he's going to pay her the difference.
Well, you can get around that
by doing an 88.
Right. The direct deposit at the bottom on page 2, you can allocate that refund to go into 2 separate bank accounts.
Right.
And once it's at the IRS, nobody can undo it.
That's right.
Right?
That's
if it's in there. So, I can't believe that they would be better off than with the earned income credit and the additional child tax credit, but maybe it would be in their best interest to file jointly. But I think in this situation, he would get hammered, and maybe he should, and she would end up with a great big refund, which maybe she should, but so no, she doesn't have to file jointly with him.
No.
And if she files jointly, she wants to make sure that she does that allocation so she gets some of that refund.
Right.
I would say
right.
At least what she lost.
Exactly. Yep. So, okay, well, this next one sort of feeds into a divorce. Kathy writes in, my ex is asking me if he could claim the youngest of our 2 children going forward. She is 13 and our oldest is 16. Should I let him, what would I be missing out of if I do this?
It all depends. Is she working?
It doesn't say. But I'm thinking the child tax credit.
Right. Well, assuming she has income.
Right,
don't know,
right. Well, we'll
right?
say she does if she files. So, but I'm thinking he knows that 16-year-old, he doesn't get the $2,000 anymore. He gets the $500 credit.
You mean once they're 17?
Right,
So right now they're 16, right?
right.
So this year you'd still get 2 for each, right?
Yes,
But next year it goes away so that the 16-year-old who's now 17 goes to 500 in 2024,
yes.
and the other kid would be 2,000.
Right. So he's probably trying to pull a fast one on you to gain the extra 1,500. And we have seen that. We probably have advised people of that too as well.
Well, and here's the thing. Let's just say that her income's like 10,000, all right? If you gave him the right to claim the kids, you still are head of the household if the kids live with you, and you still get the earned income credit if you gave him the right to claim the children.
Right.
So he doesn't get head of the household status if you guys are single, if the kids are living with you. So you'd still get head of the household. He would get the dependency if this is what you decide, but you'll still get the earned income credit. So if you didn't need that, of course, who doesn't need the $2,000, right?
Right. And,
But if she's just being a sweetheart, I don't know.
but then too, I mean, we don't know the full story here, but if their oldest child is going to go to college in a couple of years, there's up to a $2,500 credit for college if there's
And on the state of New York too.
Right. So, you may want to do it. I mean, it's got to give us a call and we will work the numbers out just to tell you everything.
Yeah, so like next year at 17, the oldest child would only have a $500 credit, but let's say that he starts college and you've given the child to dad, and dad's going to claim the $2,500 federal credit and it's like $400 on New York State. So that's a lot of money that you're giving them. So you have to be very careful, not just this year, but moving forward.
Right.
And really, and who's going to get who's going to do better with the financial aid too?
Yeah.
Got to think about that.
Yep. For
Okay,
sure.
what else we got here?
Okay. It's the women's section here. Linda. Esther, I'm thinking of retirement. I'm 61 and single. My 401k has about a $1 million in it.
Whoa.
I know that with taking Social Security, I will still need to work to help me make ends meet because of the high cost of health insurance. I know probably not the best idea, but I want to enjoy my life before I die. Both my parents died at age 65. Any advice?
Well, I mean, all right, so she has to work.
Yes.
And so what's she worrying about, I guess? Maybe I missed the upshot of the question.
Well, if she's still working and collecting Social Security under 66, actually, she's got to watch how much she makes because she'll have to pay
you
back.
mean her health insurance. You're talking about health insurance?
Right. Well, she's got to work to cover the cost of health insurance, it looks like. But, I mean, what I'm reading into this is she's got to watch her wages because she's under the minimum.
You mean the $19,000, or else
Right.
you'd have to pay back Social Security.
Right.
Okay, that I got. Yeah. Okay. So if you're under normal retirement age, which is now 66 and some months, and you're collecting Social Security, then you might have to pay back your Social Security if your wages come over, and actually it's going up every year. It's about almost 20,000 right now. So if you stuck to, Linda, making around 20,000 part-time, then you still get your full Social Security, obviously limited. You're not getting a full boat, but you're taking it early. You'll still get your Social Security, and you don't have to worry about paying it back. And so you'd pay your health insurance with that.
Right. And one thing, too, is if she is only on, she may not know this, if she is only on Social Security, her income's going to be low enough, she may qualify for free health insurance through New York State or the Essential Plan, which is like $20 a month.
Yeah.
So
there's the important thing, too. The financial guys have a health insurance specialist whose job really is to slot you into the most effective health insurance for the lowest price for your needs. I would suggest you not go that alone. Especially don't stay on Cobra if you don't need to, because Cobra is one of the most expensive health insurance plans that you possibly can do. So I'd suggest that you can call us and we can set you up with an appointment. They're located right in our office. So you can come in and talk to them so they get you the least expensive, best quality health insurance for the money.
Exactly.
Right?
Yep.
And then we'll help you with all the rest of it too.
Yep.
And enjoy yourself.
Yes.
Go to Italy. It's fun.
Esther will be your tour guide.
I love Italy. I went last year, so I loved it. I loved Italy.
Okay.
Italy.
Yes. One fast one. Hope this is an easy one for you. Should I contribute to my Roth 401k or traditional 401k through my job? So,
Well, that's not easy at all, because everybody thinks, oh, the Roth is never going to be taxed. Oh, yay. And that's true. The Roth won't. Well, then there's Congress. But you're giving up the deductibility for tax-free income later. And it all depends if later you even have a tax liability, because the standard deduction keeps getting bigger and bigger and bigger every year. So it means more and more income that would have been taxed isn't taxed. So when you're taking money out of your Roth later on that isn't going to be taxed, if it would have been a traditional, it wouldn't have been taxed anyway, if your income is low enough. So if you're somebody that didn't have a pension plan provided for them by their employer, and who's got that anymore, and you haven't been lucky enough, like our lady that had the $1 million in her 401k plan, you're not going to pay taxes later, and you're giving up the deductibility now. So we have to put a pencil to it.
right.
And figure it out. What's the best way? I'm not going to guess,
Yep.
right?
Yes.
So we're all done, Chris.
We're all done for another week.
All right. Well, I'm Esther Gilius, the tax lady. Give us a jingle if you need us, and you probably do. And we don't charge to talk to you. 632-7886. Go to our website at egtax.com. Until next week, I'm Esther Gilius, the tax lady, with Christopher Fabian. Thanks for listening. Hey everybody, this is the tax lady from EG Tax. It's we're moving on to fall. That means tax season's not that far away. So don't forget, if you want a third quarter tune-up, give EG Tax a call. We'd be very happy to tell you how you're doing, what direction you're pointed in for January. And of course, anytime that the IRS is changing tax law, EG Tax will let you know. And of course, I'm joined in studio with Chris Fabian from EG Tax, and we're answering emails and text messages right now, aren't we, Chris?
Yeah, you can, if you've been listening, you can see there's a lot more than a simple yes and no about doing things. You got to really dive into, and that's why we love these shows, so we could explain a lot of things more.
And the thing is, any of those answers that we came up with were all right, but some of them were better for the financial person's long-term goals. In other words, they were all mathematically correct. The IRS would have said either of, whether you do a subchapter S or you do a LLC, or if you don't do them, or if you put in a pension, we don't care what you do, right? And all those answers were right. But the truth was, there is an answer that's best for your finances. And if you don't know to ask, you never know, and you can really miss the boat.
Right. Yep. So.
Okay, what do we got now?
Okay, Tom writes in, I want to get an electric vehicle. My wife and I have around $40,000 in income, all Social Security. Will we qualify for those big credits?
Well, yes, they qualify. Will they get any benefit for it?
No.
No. So there's now several things that they can do. So let's say, and why is it that, well, let's first explain why they get no benefit, Chris.
Sure. Well, because their income is only Social Security, so then they have no tax liability. So this credit is a non-refundable credit. So since their tax liability is zero, they're not going to give you any more money back, so you're not going to get that $7,500 credit.
And that's where you can put on your thinking cap. So you got the state of New York's going to give you up to $2,000. The federal government's going to give you $7,500, $9,500. Let's say that you have $100,000 sitting in an IRA. If they took the money out of the IRA, that means the $100,000 would be taxable, right? And well, that'd be too much. Let's say $50,000. If they took $50,000 out of their IRA, and that would put them maybe in the 15% tax bracket, which would be $4,500, but then part of their Social Security is going to be taxable. They could use a lot of those credits to offset the money that was due on the distribution from the IRA that they have. Now the IRA has all been taxed, and it was covered by credits. That's one thing they can do.
Right.
Actually, and if you called us, we'd tell you exactly. I mean, we'd work it right out so you knew exactly what to do. The other thing is these credits on these electric vehicles, and if you got to make sure that they qualify for both of the credits, because one of the credits is based upon the minerals, and the other one's based upon the battery size. Okay, so you got to make sure that in order to get the $7,500 credit, that you're going to qualify on both ends, and they have to be assembled in the United States or Northern America. But what you can do is they say that the $7,500 credit is freely transferable. And I don't know how it's going to work yet, and I don't think the IRS knows how it's going to work yet. But you can negotiate with the car dealer and ask them to put that on the deal to purchase a vehicle as a down payment. Then the dealer will get the $7,500 credit.
Right. So it will reduce. It's like
The
a
cost.
rebate. It reduces the cost, which would reduce your loan or, your out-of-pocket expenses.
Right.
So
I mean that's and right now they are very. I mean they haven't written the regs yet that I can see.
right. And the thing is too, for everybody else who does qualify, the car dealership.
Well, make sure you qualify. Do you think people really know if they qualify?
Well, that's what I was going to say. The dealership has to give you the federal form filled out for you to give to your tax person. And that tells you qualify or not. If they don't give you a form, there is no credit.
Right.
I'm-
But further, you may think that they give you the form, you got the $7,500 coming and $2,000 from New York State. Then it's tax time, and you say, well, how do we not get this big credit? Because you might have 4 kids under the age of 17. And you have an $8,000 credit for a child tax credit. And you had a liability, but when you apply the child tax credit, it's zero. So now you got this EV credit that you can't use.
Right.
So make sure you call us first.
Yeah,
Even if we didn't do your return.
Right. And, one of the stipulations is the e-car has to be under $85,000. So if you bought a $90,000 electric vehicle, you don't qualify.
Yep.
The income limit for e-cars, I believe it's $350 for a married couple.
I think it's 300.
300. Yeah, 150 and
150, 300.
Yep.
So a married couple might want to file separately. Maybe her income is $100,000, and if they put it together, it's over $300,000, and maybe one of that. And I guess, when we do these shows, I guess I get this thing. I think, wow, look at all the angles you have to think about, right?
Yep.
And it's not just simply, I'm going to take that red one right over there. Then you find out that you don't get the credit.
Yeah, I know you always used to say it's like shooting billiards. Do I use backspin? Do I use right spin? Do I want to bank it? Do I want to hit it straight
Do I
in?
hit the striped ball first? Or do I hit the black ball first? Yep. Okay, so that's how it is with the EV credit. And I will tell you, It's very difficult because I don't think a lot of the dealers know, and I'm going to tell you, I don't think the IRS knows yet. And so call us. We will do the research for you.
There you go.
And what else we got here, Chris?
We got Bob writes in, my daughter just got diagnosed with severe anxiety, and we were told to get her a dog to help keep her calm.
Aw.
Can we use any of the expenses as a write-off on our tax return?
Well, maybe, right? Because if it's a medical condition, then the expense of keeping a medically prescribed dog, like a seeing eye dog or an emotional support animal, would mean that you can take as a medical expense the cost of keeping the dog healthy, the vet bills, the food, et cetera, but it's a medical expense. So that would mean that it has to be reduced, that total amount of keeping the dog gets added to all your other medical expenses, and then that is further reduced by your adjusted gross income. Right, Chris?
Right. And, and the thing is, with the dog, I mean, I know the big thing is they say it can't be a pet. So I know, like, for the blind, because you had clients who would train dogs.
Right.
And the people would have to get new dogs every 2 years because it's
Yeah,
not
they
a
were
pet.
guiding
eye dog. So I'm not sure. I don't know about anxiety dogs.
Well, I think if it all depends on, everything's going to come down to, is it ordinary and necessary?
Yep.
Right. So if the doctor says, this kid might be suicidal, right?
Right.
If the doctor says this has absolutely been proven and this is the happy dog place and they make their point, certainly you'd be entitled to your day of court in court, right?
Right. I know I'm seen TV shows, Ninja Warrior, and these athletes have dogs that help detect sugar levels and different things like that, and will notify the human that,
Right.
hey.
And now realize we're absolutely saying that this has to be a medically indicated situation. The doctor has to go to bat for you. Sometimes I'll be flying on the plane and people will come in with these cute little dogs. They are so cute, and they'll say they're my emotional support animal. Yeah, sure they are. Sure they are.
Yeah. But
really they have to be.
Right. But if they do qualify, then that just opens up a whole slew of other items you need to keep track of for medical purposes. For instance, your prescriptions, your co-pays, your emergency rooms, your lab costs.
Your Medicare, if you're on Social Security,
Yep.
Medicare Part A and B,
Yep.
right? Your health insurance.
Your health
Glasses, dentists, dentures, the whole, everything that you do to keep yourself hanging together. And as you get older, it's harder and harder, I'll tell you. But
Wait, does that mean-
that all gets added together. And then what's the floor that it has to come over, Chris?
7.5% for the
your
federal,
adjust-
10% for the state
Right, of your adjusted
of
gross
your
income.
adjusted gross income. So,
So they take that away. So if all your medical came to 10,000 and your income were 100,000, then they're going to take 7,500 from the 10,000. All you get is a $2,500 deduction, right?
right. Yep.
Okay.
So then we have, I understand there is a new energy credit this year. So if I put in new windows, what will it save me? How about remodeling? Terry.
Okay, well, how about remodeling? Doesn't everybody every year say, and they're pulling out all the receipts, I remodeled my kitchen. And here's my thing from the guy that did my kitchen, and it's a capital improvement certificate. First of all, what does that mean, Chris?
That just means you don't pay sales tax on the material you purchased.
That's what the capital improvement certificate means, that
Yep.
even though they bought $10,000 worth of cupboards, you don't have to pay $875 in sales taxes because it's a capital improvement, but it's not a deduction on your federal return or state,
Right.
right?
Yes.
Okay. But under the new energy efficient home improvement credit, you can take a credit against your income, and again, it's non-refundable, up to $600 for each window that you do, limited to $1,200. So that would be two windows. Doors are $250, limited to $500. You can take $2,000 for qualified heat pumps, biomass stoves, and biomass boilers. So really, you can save $3,200 by doing your energy costs. But remember, they have to qualify for what's the word?
Energy efficiency.
Yeah, but there's
the ratings.
the SEER rating,
Yep,
right?
that's it.
So, so you just can't put in. You can't say, "Well, they were really thick windows." They have to be the ones that qualify for the energy credit. But remember, it's $600 per window. It's 30% up to $600 per window, $1,200 total. Doors, $500, $250, maximum $500, and home energy audits $150.
Right, and they got rid of the lifetime amount.
Maximum.
So now it's every year you qualify.
Right.
And they have to be installed to qualify as well. You
And it
can't,
has to be your personal residence.
yes.
Okay.
Yep.
All right. Do we have time for one more?
Nope, time for a break.
All right. I'm Esther Gullius, the tax lady. We'll talk to you on the other side. Hi, this is Esther Gullius, the tax lady from EG Tax. This week we're answering your emails, so no live phone calls. But of course, during the week, if you have questions, you can always go to our website, Ask the Tax Lady. I'll be very happy to answer any of your questions, or you can call us at our corporate headquarters, 9 to 5, Monday through Friday, 632-7886. But we're answering your emails, which we can spend a lot more time on when we're answering emails. So we have, and of course I got Chris Fabian with me. Hey, Chris.
Hello.
Hello. Okay, so what's our next one?
Okay, I think this is going to be a very common thing doing taxes this year. Sean writes in, Esther, why did my friends tell me not to pay for a group meal and get reimbursed through Venmo like we used to? I like getting my points on my credit card.
Well, because last year they were talking about issuing third-party pay 1099-K forms on the 2022 tax return. But when push came to shove, they changed it and said, no, we are not ready to keep track of everything, so we're going to push it off to 2023. This is 2023. So if you received money from a third-party payer, Venmo is third party, right? Your buddies gave Venmo the money and Venmo gave you the money. You're going to get a 1099-K form for the dinner that you got reimbursed from your buddies. And let's say it's $500. Well, anything over $600 in a year, you're going to get a 1099-K form. So if you did this several times, you're going to get a 1099-K form for dinners that you got reimbursed for, so you can get the points. But the IRS is going to think you have a business of buying people dinners.
Yeah. You know, and I looked the other day at Venmo. I rarely use it. And everybody talks about there's supposed to be a friends and family button that you click on when you're doing it that way, so it won't count towards the 600. I couldn't find that. I couldn't find that little click button to mark it. So
and you know, people, you know, you're in a hurry, you're in a restaurant. People don't think about doing that then.
right.
You know, I mean, that you would think, oh, taxes. You know, but here's the thing. If you get more than $600 from a third-party PayPal, Venmo, what's some of the other, Cash, I think there's a Cash App.
Cash App, yep.
You know, then they're going to send you a 1099-K. The IRS is going to assume you're in business and look for either the Schedule C for self-employment, the Schedule E for rental property, the Schedule D for sale of stock, sale of an asset, or a miscellaneous box where you have to just put the income in and explain what it is and then back it off. And so that's going to be something that could cost you a lot of money. So you want to make sure, number one, that if you're just getting reimbursed, that you really think this over, because it could be 10 time-consuming and a hassle on your tax return. And number two is are the points worth it?
Right.
Probably not.
Right. The headache. And, the thing, you just said it. There's 4 possibilities where this income can get reported to the IRS. How many letters do you think we're going to see in a year and a half?
People don't understand.
Right. Or the IRS does, their computer is looking for it on a Schedule C, and it was reported as an adjustment, a schedule on the Schedule 1, and we're going to have to write a response saying it was reported, here it is,
Right. And here's the other thing. I said the Schedule D because many people sell things on eBay. That's another third-party pay. And they might sell their couch or some pictures or an old rug rather than doing a garage sale. Well, then PayPal will issue the 1099-K for you, and you'll have to report that on a Schedule D. And you say, my gosh, I have to report my old purses that I sold on a Schedule D? If you made money off of them, if you sold the purse for more than you paid for it, then it's a capital asset and it's taxable. If you sold the purse at a loss, then it's not deductible, but you still have to report it and then back it off as a no gain. But it's not a deductible loss. And the third thing is, let's say you're selling Bills tickets, right?
Yep.
Well, or a collectible. Let's go with the collectible. Let's say that you have trading cards that you're selling. Not only is that subject to capital gains rate, but it's subject to collectible rate of 28%.
Right. So you might, you're not in the business of it, so it doesn't go on a Schedule C. It's just a one-time thing. So that is a collectible.
But of course, if you're selling Bills tickets, they're going to think that you're in the business to sell tickets. So maybe some people are. Then you have to put it on a Schedule C and reduce it by your cost basis. Well, have you been keeping track of your cost basis? Right?
Right.
Like, for instance, let's say at Christmas time, let's say you hate the Bills. And at Christmas time, your friend gave you a ticket to, I don't know, the New England game. And you think, I don't want to go, or you can't go. So you put it on StubHub and you sell it. Let's say you sell it for $1,000. Well, what's your cost basis in that?
Well, your cost basis, it's a gift. It goes back to the original cost basis.
Right. So you'd have to call your relative that gave you that ticket, and if it was $50, then they'd have to keep track so they can show you what you paid for it. Then on StubHub, you'd have the $1,000 that you sold it for less the fees, and that would be your gain.
Yep. And you talk about basis. What if it's something that you had as a kid, you bought 25, 30 years ago, and now it's worth money. You had a Spider-Man lunchbox. What is your cost basis? You don't know. So,
well, probably it's $1. Right? 20 years ago, what would a Spider-Man lunchbox cost? Because it wasn't a collectible then.
Right. Well, that's what I'm saying. According to the IRS, if you don't know what your cost basis is, they go by zero.
Right.
So
the whole thing would be taxable. But here's the whole thing. If you just really need to put your antennas up, if you're getting money from anybody other than directly from that person, or they're paying you on a credit card, because that's third-party pay, Venmo, PayPal, all of those other, you will get a 1099-K form, and you have to report that on your tax return. Otherwise, they're going to send you a bill with penalty and interest.
Yep.
Okay.
Okay, so we beat that one to
And
death.
at the IRS, when we went to that IRS convention, they were really excited about the 1099-K form. Weren't they?
Yes.
There were lots of seminars on the 1099-K form.
Oh, yes.
Okay, what else we got?
Okay, I have 5 rental properties and about to buy 2 more. Mm-hmm. Should I incorporate or become an LLC? And do I need more of one of these businesses? Al.
Do I need more?
Well, I guess maybe should he do 4 different LLCs or
Oh,
4
I
different
see.
corporations?
Well, I mean, it really comes down to, well, being in, it all depends on whether there's more, in first place, are there mortgages? Because if there's mortgages, will the bank allow you, if they're holding paper on these properties, will the bank allow you to change ownership to the corporation? You'd have to check with them first. Because they'll let you do an LLC because the individual owner is still responsible. But to say that on a building with a mortgage, that the bank is going to allow you to put it in a mortgage is, you'd really have to check with them.
Right, right.
But as far as benefit, both of them are going to protect the value, your personal value of other assets, because if something happens and they sue you and it's in an LLC or corporation, all they can do is take the value of the asset that they're suing, unless there's gross negligence, and to pay the liability in a lawsuit. To be quite frankly, if you did all of these rentals in one corporation, then you have a lot more assets that they could get. The LLC, if you did them individually, each one is individually protected. However, on the flip side, if you put it in a corporation and the corporation hires you to be the manager, then you can set up a pension plan, which is a great thing to do at the same time.
And not also, not just the pension. How about it sets you up on a payroll? So then you're paying into Social Security, so you
Right.
keep building your Social Security up.
Right. And then if it's a corporation, then you can also take the 20% deduction for your business if it has a profit.
Right, the QBI.
The QBI, right.
Yes, yes.
So there's definite benefits to incorporating, but there's definite benefits as well to being an LLC. To be quite frank with you, I think if it's at the beginning stages of the investment where you're probably operating at a loss because of the cost and the depreciation, probably the LLC might be the best thing to do. And at some point in time when it starts making money, the businesses start making money and they can start paying you a salary, you can always move it to, and maybe they're paid for it by then, you can always move it to a corporation.
Right, yeah. I mean, the end result, if it's a loss, they both are on your personal return, whether it's a corporation through a K-1 or an LLC, reported on the Schedule E. The losses are on your return, so they're going to have the same answer. It's how you want to be protected and your future plans with the property.
Provided that your income isn't over between 100 and 150
right.
because it starts to phase out.
Right, yep.
So, that's where the benefit of putting it in a corporation and having a maybe solo 401k, which means that you're going to get the benefit of that deduction and that benefit, and and that would then reduce your overall income and maybe get it so that you're in that perimeter between 100 and 150,000. But if you're a real estate professional, then that changes everything because you get to take it no matter what your income is, right?
Yes.
Okay, we got to go to the news right now. I'm Esther Gullius, the tax lady. Talk to you on the other side. Hey, I'm Esther Gullius, the tax lady from EG Tax, and thanks for listening to Ask the Tax Lady. Normally, we have you call in and ask tax questions, and I usually have something I want to talk about, but today we're answering emails, and of course I got my buddy in studio with me, Chris Fabian. Hey, Chris, how you doing?
Hello, Esther.
Hello, Christopher.
I'm doing good.
So now we're getting close to that time of year. October is just a couple months before the end of the year, so it's kind of cool to answer people's emails because we can really get into some detail of why the laws are written a certain way, and if you change something, you might get a different answer. And so we're just going to do emails again today, right?
That's right. But also, our tax schools have started already, but we will be offering a crash course coming up soon. If you're still interested, you can give us a call at the office at 632-7886, and we'll give you more information on that.
And you can take it online too, right?
You can take it online. That's right. So we're, and like
So no matter if it's right now, this being October, if you want to do it right now, you can still do it online and kind of catch up as you would.
correct.
Right?
Correct. Yes.
Okay, so no phone calls this week. We'll have phone calls again next week, and text. But right now we're going to do emails. So what's our first one?
It says, Tax Lady, my mom had me listed as the future owner of her home by the way of a life estate. Her house cost $200,000 15 years ago, but today it's worth $450,000. If we sell it now, will we use the original cost? I've lived with her for the past 5 years.
Okay, so there's a lot of twists and turns in this thing. So because the son lived with the mother, right? He would get the same up to, assuming he's single, up to $250,000 exclusion of the gain, and mom would get an up to $250,000 exclusion of the gain, assuming they're 50-50 owners because they lived in the house for the last 2 out of 5 years, right?
Right.
So now that's assuming that she's still a 50% owner. But in a life estate, little by little, more of the house is given over to the heir. But then again, she hasn't passed away. So assuming that she doesn't, if she still owns half, then it's going to be tax-free. The first $250,000 is going to be tax-free. If she doesn't own any or a very small portion of the house, then he's going to be limited to $250,000 of the gain. Well, so you're looking at a $200,000 original cost basis and selling it for $450,000, that's $250,000 right there. So they're not going to pay taxes no matter what.
Right. Yeah, the gain is only $250,000, but
Right.
I would say just double check with the lawyer to make sure how it's treated. Was it a life estate? Was it a gift? Did she even do anything? So
Right. And the thing is, if she didn't own it and really you're the one that's on the title, then the gain's going to be tax-free. If she owned half of it, well, then you're still looking at that 5-year look back, right?
Right.
So if she had to go into a nursing home and wanted to use and wanted to qualify for Medicaid, that would be a fly in the ointment. So you're absolutely right. I think she has to really go. She and her son have to go look with the attorney and see what position it is, and then give us a jingle at 632-7886, and we're very happy to tell you which of the laws would favor you based upon who actually owns the house.
Right. And then don't forget too, even let's say the house was worth $500,000. You get to add all the improvements mom did over the 15 years. Like if she redid a bathroom, the kitchen, put on a roof, put in a generator.
How about if mom was married to dad and he passed away 2 years ago?
Right. Then there's a stepped up basis.
Stepped up basis, right?
Yep.
So, yeah, it can be very tricky. The important thing is you got to figure out who really has title to the property when it's going to be sold, and then give us a call and we'll work out all the numbers for you, and we do that as a free service.
Right. And, that's a very common question we get all the time about a life estate or selling mom's house. And, call us before it happens so we can advise you, what to watch out for.
Yeah, and many times we send you back to your employer, we send you back to the attorney, because what you think is the situation, many times when you go talk to the powers that be, you find out that what you thought it wasn't. And that changes the whole answer.
Oh, yes.
Yep.
That's for sure.
Okay. So now what's our next one here?
Let's see. Claudia writes in, I had a windfall year with my business this year. I have a small business and I assume my net will be over $150,000. What can I do to reduce my taxes? I have no employees, just me. I'm pretty worried.
Well, I mean, if this is a small business with that kind of a net profit, she can set up a solo 401k, can't she?
Right. Yeah.
And dump a ton of money into her solo 401k. I think it's like $45,000 plus the plus the business can do a match. So I think that she's limited this year to around 57,000 that she can put away, which would be not taxed at all. Now the FICA, she's going to still pay on the 150,000 if that's her bottom line, but she still has time to buy assets that she can also expense if she needs them in her business, if that's what makes sense.
Right. I was just going to say, what does she do? Does she need anything that, like, does she drive a lot for her business? Maybe she can get a new car, a new truck. You know, a truck especially had the $25,000 write-off.
Right.
Computers, you know, different upgrades that she...
And the thing is, with these kind of with a bona fide expense, that reduces the net profit, which then reduces the FICA. However, when you put money into a solar 401k plan, for instance, or any or any pension plan, you still have to pay FICA on the entire net profit. So the 15.3%, she won't be able to. She wouldn't be able to reduce if she uses that pension plan. But think about it: if she could put 50,000 away, if she has that ability to be that free with her net profit, she would save at least with state of New York about $12,000 in taxes just there. And then, like you say, if she were to buy an asset, maybe she needs new computers or desks for her company or a new sign, right? All those kind of things all add up. But don't go spend money just to save taxes. Right?
Oh, my God.
That doesn't make sense.
No. How many people do you see that? Well, I'm going to go do this. Okay, well, you want to spend $10,000. Right, because it's going to save me a lot of money. Okay, it's going to save you $2,500.
Right, and you spend $10,000 to save $2,500.
Yeah.
But obviously, this is the way the federal law works and the state law works. If you need it and it's to make money, then they allow you to take the expense if you need it. But if you are just spending money to reduce your tax liability, you're actually on the losing end of the stick because you're only getting a percentage of what you spent.
Right. Yeah, you got to look at the needs and the wants. You know, what you really need is what you want to spend the money on. What you want, you may not want to spend the money.
And the other thing in tax law, everything has to be ordinary and necessary. Right?
Yep.
So if you just go buy yourself 18-wheeler and your business is typing term papers, you'd never be able to justify that. That certainly is not ordinary, and it's certainly not necessary.
Right. Yes.
So they would disallow. So you want to make sure that's what we're there for. We answer tax questions all the time. Right,
Yep.
Chris?
Yes.
And before you do it, just because there's all these little things in there in the law that makes it deductible or not deductible. And we want to make sure that financially we do the very best for you. So I'm Esther Gulius, the tax lady from EG Tax. No texts this week. No phone calls. Next week we'll be back in studio taking your phone calls. But this week we're answering emails. So I'm Esther Gulius. We're going to take a short break.